President Donald Trump announced unfortunate news for stock market investors on Monday as he sent letters out to the United States trading partners imposing higher tariffs that were paused for several months, and investors were hoping that a deal could be reached lowering tariffs on the United States trading partners. So I'm going to talk about the details of these announcements, what it could mean for stock market investors, some companies specifically that could be negatively impacted, and some companies that will result in positive implications for stock market investors. So let's digest this news.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Right, so stocks pulled back from their all-time highs on Monday as President Donald Trump said that the United States will impose 25% tariffs on the imports from Korea and Japan starting on August 1st. Additionally, there will be several other countries, including South Africa, Malaysia, and others, that will have tariffs ranging from 25% to 40%. So these tariffs were originally announced in April and then put on pause as stock market investors reacted negatively to the news and stock markets started crashing. U.S. trade with partners started to collapse, and the worldwide economy started to get paralyzed, to use one word. And so President Donald Trump paused those tariffs to give the markets and businesses more time to adjust to these huge changes in how businesses import products and manufacture products. And now, after several months of negotiations with countries, there were only two deals that were made, one with the United Kingdom and one with Vietnam. And even in those deals with the United Kingdom, there will be a base 10% tariff and some additional tariffs on component specifics. And even with Vietnam, there will be a base 20% tariff in addition to other tariffs on industry specific items. And so even when there is a deal being made, tariffs are much higher than from before the current administration took office. So I think what investors can take away from these initial developments in the first few months of negotiations is that tariffs will be much higher. Businesses that rely on importing products from outside of the United States will have to pay higher costs to import those products. And that's nearly every business in the United States. Even if it's a US based company that has manufacturing facilities in the United States, they still rely on importing products from overseas in order to manufacture in the United States. They rely on components, they rely on manufacturing equipment and other products that go into the manufacturing even inside of the United States. I've recently evaluated companies like Rivian, which only has a manufacturing facility in the United States, but still they said they will be impacted from the higher tariffs because of the cost of components that are going into their manufacturing facilities and the equipment that go into their manufacturing facilities. They will have to pay a higher cost of goods for that material import, and so subsequently their costs will rise significantly as a result, even though they are a US only manufacturing company. So that's just one sign of how intertwined our worldwide manufacturing facilities are. And the supply chain is so intertwined that even US based companies are going to feel the pain from these higher cost of goods to import. So, unsurprisingly, the stock markets are down, and I'm actually surprised they weren't down even more. They're down by about 1%. And I've been talking over the last few months how investors have gotten a little too comfortable about the situation regarding tariffs and manufacturing and the cost of goods sold. And stock markets had risen to all-time highs, even though there hasn't been any real resolution to the increase in trade, to the increase in trade barriers and the increase in cost of goods sold, which will result in a reduction in worldwide trade. That's typically bad news for stock market investors because of how intertwined supply chains are, like I mentioned earlier, especially for US based businesses. Most US businesses rely on importing from outside of the United States. China in particular is a major country of import. That's why the United States has such a large trade imbalance with China, because companies like Apple, Nvidia, AMD, and others rely on manufacturing outside of the United States. They design their products here and they have them manufactured outside the United States, and then they import those products back to the United States and are able to sell those products for US consumers at lower prices because they manufacture outside the United States. Additionally, companies like Amazon, Walmart, and Target import a very large percentage of the products they sell in stores from outside the United States. So all those companies will have to pay higher prices for those things that they are importing. Now, what do you think they're going to do as a result of having to pay higher prices? Are they going to absorb those higher costs? Unlikely. Or are they going to pass along those higher costs to customers and force customers to pay higher prices or not to buy the item? So, as we approach the back half of 2025, US consumers can expect to see much higher prices when they go shopping for nearly every product, and also lower items in stock. Businesses are going to be more selective in the products they manufacture because they understand that when they raise prices that consumers face, consumers will spend less money, right? I teach this in my economics course at university every semester. Supply and demand, right? When price goes up, demand goes down. So when businesses raise prices, consumers will buy fewer items as a result of higher prices. Now, this is all happening with US consumers facing tighter budgets. Unemployment has been steady. Unemployment hasn't been increasing by all that much, but especially the lower end of the US consumer is facing significant constraints. They're looking to make their dollars stretch further. And so, as they face higher prices for these things, their behavior is going to shift. It's my prediction, it's my forecast that consumer behavior will shift away from purchasing goods and more towards purchasing services. So companies like Walmart, Amazon, Target may suffer as a result of these higher costs. And then companies like Netflix may benefit as a result of these higher costs. Disney is another one that might benefit from these higher costs. Companies that may not be publicly traded, companies that, in industries more fragmented like barbershops, salons, etc., might see a benefit initially as a result of the higher cost of goods, as people will look at their spending and say, well, I can spend $100 on this physical item, or I can spend $100 on this service. And comparatively now, the value looks much better spending money on services rather than spending money on goods, because the cost of goods is going to increase significantly, while the cost of services initially are likely to remain the same. And then over time, I expect the cost of services will also increase, but initially, at least, the cost of services will remain relatively flat, while the cost of goods will increase. And so consumer behavior will shift more towards services and away from goods. So the takeaway so far, what I've seen between President Donald Trump's negotiating team and what we've seen so far, it looks like it's going to result in higher tariffs, regardless if there's a deal or not, right? We've seen two deals with the United Kingdom and Vietnam, and in both of those deals, it resulted in higher tariffs on the United Kingdom and Vietnam. And then countries like Japan and South Korea, it looks like they've been tougher at the negotiating table. And so President Donald Trump and the United States negotiating team just decided, you know what, here, just pay this tariff. The tariffs are going to be higher anyways. Let's just make the tariffs higher. And then if you want to negotiate, we can negotiate later. So if you're thinking about what kind of stocks to invest in, what kind of businesses to invest in at the increment, at the margin, that's going to be the shift that I'm predicting, more to services, away from goods. Of course, businesses will adapt and great companies will continue to perform well. Companies like Amazon, Walmart will continue to perform well, even though they will face the higher cost. they'll find a way to work around it. They'll find a way to generate earnings growth in the long term. But in the near term, their profits will be impacted negatively as a result. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.